Hello everyone. In this video, we'll be going over how sector-based pairs trading works and how you can implement it using the Python programming language. Without further ado, let's get started. Before we dive into the code, we first have to go over some basic background information. Let's start by going over what pairs trading even is. Pairs trading is a market-neutral strategy that allows the trader to profit from the difference in returns of correlated assets. The most familiar example of this is the Coke and Pepsi pairs trade. Both Coke and Pepsi operate in the same industry and are exposed to similar risks and similar upsides. So generally, the performance of these two stocks tends to be similar. However, when the performance of these two stocks diverges by a significant amount, for example, Coke goes up by 5% while Pepsi only goes up by 1%, the trader profits by buying the underperforming shares, in this case Pepsi since the percent return is lower, and they would go short the overperforming shares, which in this case is Coke. A profit is realized when the spread between the two stocks decreases. It isn't necessary for both legs to converge in opposing directions, and oftentimes profit is made when just one leg of the trade catches up and closes the spread. In that scenario, you would lose money or remain flat on one leg, but you would make more than you lost through the leg that catches up. So that's the meat and bones of how pairs trading works, but this strategy has been used and studied for decades by now. So while opportunities in stocks like Coke and Pepsi exist, they aren't really significant enough to be worth the effort. However, there are a few other areas of the market where this strategy can be extraordinarily effective. Let's look at this from a sector-based perspective. Pairs trading works because the stocks involved often have valid economic reasons for being correlated. This can be due to stocks being in similar industries, stocks that represent different rights to the same company, or stocks with similar macroeconomic exposure. As you expand the scope of stocks looked at, you will notice that while the correlations remain strong, they become imperfect, but this is where the largest opportunities lie. So, we first ask the question, how correlated are the 10 largest stocks of the technology sector? To answer that, we pulled about a year of data and ran a correlation matrix for those stocks, and this was the output. As demonstrated in the first matrix, the 10 largest stocks of the technology sector are strongly and positively correlated. But does this relationship extend to other sectors? We ran the same test, but for the financial sector. As shown by the bottom matrix, while the correlations aren't as high as the technology sector, it is clear that there are still strong and positive correlations between the 10 largest components. So, since we can assume that the largest stocks of a given sector will have strong correlations, we can use it as the basis for a pairs trading strategy. This strategy will take the top 10 stocks of a sector, then it will split the basket in two. Considering the high correlations, the performance of these two baskets should be very similar. So when the performance of these baskets diverge, in other words, widening the spread, we can buy the underperforming basket and then short the overperforming basket. Thankfully, the QuantGlobal API handles the bulk of this work for us, and we can get our universe in just a few lines of code. So, let's boot up our Python environment and get started. Let's get started by installing the packages we need. We want to import data, manipulate it, and then finally show it. So all we need is Pandas, matplotlib, and the QuantGlobal package. We recommend using the Spider IDE as it carries the extremely useful variable explorer, which we will see in action later. Since we're setting up a pairs trading strategy, we will need to create two variables. We will call the first variable underlying data, and this will hold the data for the top 10 stocks in the sector. Next, we will call the second variable index data, as this will hold the data that contains the spread values. After running those lines, let's use the Variable Explorer to dive into what the data looks like. As you can see, The underlying data variable contains the open, high, low, close prices of each stock in the total basket, and it also displays columns that describe the returns, volume, and the specified ticker. The returns column simply shows the percent change of a stock at each given minute, and the cumulative returns column shows the total performance of each stock. Another way to think about the column is starting each day by investing $100 in each stock. If in 5 minutes, the cumulative return for a particular stock is 101, it means that the stock went up by 1%. The index data variable contains the spread at any given time. This is where the trade signal will come from, as it represents the spread that we are basing the pairs trade off. As mentioned in the previous slides, the spread is calculated by taking the absolute difference in returns of the two baskets. So, now that we have our data imported, we need to create a logic for identifying which stocks we will long and which we will short. It might be a bit tricky to navigate buying and selling 10 different stocks at once, so for this example, we'll trade using just 2 stocks out of the 10. The 2 stocks will be the highest performing share and the lowest performing share. This pair will have the largest effect on the spread as they are the outliers, and as such, they offer the largest profit opportunity. To identify this, first, let's get only the most recent values. When we look into what this data holds, we see that it is only the values at the corresponding timestamp. So now that we have only the most recent data, let's get the tickers that we need. In these lines of code, we select only the ticker value from the data frame where the cumulative return is equal to the smallest and largest value. If we head over to the variable explorer to see what those are, we see that the underperformer is Morgan Stanley and the overperformer is Wells Fargo. We can double check this by going back to the most recent data frame and seeing where those 2 stocks lie. As demonstrated by the cumulative returns column, the strongest performer is Wells Fargo and the weakest performer is Morgan Stanley. So, now that we have the tickers we need for putting on a trade, let's create a test logic that would put on a trade for us. First, we need to identify what the triggers for putting on a trade are. Since the strategy is based on the spread, we will assign an opening and closing threshold, so that when the spread crosses either, the program makes a trade. Let's go over this line by line. Just a disclaimer, we are using the broker API module just as a placeholder for explaining how the ideal trade logic would work. When implementing this yourself, you would need to use your actual broker's API to submit the trades. First, we assign our threshold values. The opening threshold tells us that if the spread goes above 0.75, we will want to put on a trade. The closing threshold indicates the level that we want to see the spread at before closing the position. Assuming an entry and exit at exactly the thresholds, this will lead to a profit of at least 0.50%. Next, we create the logic that checks the spread for a condition and then executes the trade based on that condition. We first check if the most recent value of the spread is above the threshold, and in the same line, we make sure that we don't already have a trade on. If the last value is indeed above the threshold, the next block executes. The program would buy the underperformer and then short the overperformer. Then the trade status is set to 1 to indicate that a trade is on. Now, assuming that we already had a trade on and the first condition was false, the program moves to the next condition. Here, we check if the most recent spread is below the closing threshold and that a trade is already on. If this condition is true, then we will close the position by selling the underperformer and buying back the overperformer. Then the trade status is set to 0 to indicate that the trade is off. If none of these conditions are true, then we pass and do nothing. While this example featured just one implementation of this strategy, There is essentially an infinite degree of flexibility in how it can be further optimized. For example, while trading all 10 stocks in the baskets may be difficult to mentally manage, it can significantly reduce the overall volatility while significantly increasing the scalability. Another possible optimization of this is continuing the pattern of taking just the 2 outlier stocks, but instead of just those in the financial sector, how about 2 from all the sectors? Our API provides unlimited access to all the data you need to explore and implement these ideas, and we make it easy for you to get started. Visit our link in the description to start exploring our data for free. If this video taught you something you didn't know or even just sparked your interest, feel free to let us know below.